Thank you very much, Bruce, and thank you all for coming today. I hope you enjoyed Curtis's piece on autonomous driving, the promise for all of us to have an automatic chauffeur. Most encouraging for us who are aging and having deteriorating sight. I have nothing but joy to tell you today if you want to hear it. I have sadness for those who want to be cautious. So, if we look at the economic environment, we have a situation which is really quite rare. Most of the economic indicators, and we can find very few contrary ones, are extremely positive. So we have markers like the Purchasing Managers Index, which is an index, this is a global index of employment situations in manufacturing, orders, production, stock levels, and so on. There are 5 indicators. They're all, and the index is now 53.5. It was about 50 in the middle of last year. We see metal prices rising strongly. We see the steel price having really taken over. We see oil prices back towards 60. And the interesting thing is the official forecasts for oil consumption seem to get it wrong most of the time. They are underestimating the global demand for oil. They've been talking about 1%. It's actually running at about 1.5%. So the world's using close to, I think it's about 96 million barrels of oil a day. So there is plenty of stock around, but to me it's suggesting that the oil price will go higher still, but not out of control, we don't think. What is notable, though, is company earnings are following this economic environment. Company earnings almost across the board are very strong. We have these reforms continuing in China. This is very important because why we go banging on about China, it has been the principal driver of world growth, and we need to get that approximately right. Andrew will follow me and talk more about China because it is a most essential part of this jigsaw of markets. Even Japan is surprising. So what we're seeing here is company balance sheets are immensely strong. They have something like 400 trillion, so about $4 trillion sitting there in cash, some of the strongest balance sheets around. You're seeing changes. We continue to get sort of obstruction to our idea that Japan was an interesting investment market, and the obstruction was, no, you don't understand, the population's shrinking and you've got all these structural issues. In fact, the population in the workforce has grown because the participation rate, notably by women, has grown immensely. So it's something like 67% participation by women in the workforce now, which is an interesting change from those who wish to draw and extrapolate from what they saw before. The important point is, in markets that are pretty expensive, we are still finding some opportunities. So, in concurrence with this apparently magnificent environment, there are still some pockets of value that we can find. And what is encouraging the general enthusiasm, of course, is the fact that we haven't had general price inflation in the traditional sense. We've had plenty of price inflation in assets. And in fact, what you're seeing is the unusual situation where people like Dalio of Bridgewater is talking about the central banks missing the picture because they're focusing on the average when in fact there's a large part of the population who are finding life quite difficult. And with interest rates creeping up now at the short end, this is becoming more apparent as you are getting coverage, whether it's the BBC, American media, or even Australian media, about the pressure on incomes, particularly that discretionary spending power is under pressure. But even today, we remain in a situation where the ECB is buying back, I think it's running at 60 billion euros a month, which is way ahead of any deficits that are being created by governments in that part part of the world. And you might want to keep in mind that even when QE was rampant in the States, they never bought back more than was being created by the governments. This is not the case in Europe or Japan. So there's plenty of money still flowing into the system. And the question we all ask is, where can I get a return? Where can I get a decent yield? The Eurozone is still negative at the short end. Japan, you get nothing for sitting in cash, literally. And in the US, we are seeing tightening. Now, this is the thing you need to watch, because rates at the 2-year end of treasuries have moved from 0.8 to 1.6. So they have moved. And at the longer end of the 10-year end, you've got rates moving up from about 1.75 to last night 2.43. So rates are moving up. Unequivocally, they're going up, and we're getting a new head of the Fed in all likelihood. And that is an interesting thing to keep focus on. So the picture is good, but as we heard after the crash of Lehman's, no one saw it coming. So in our pursuit for trying to avoid ever needing to make that statement, we'd point out a few other things. I mentioned weak income growth. That's across most countries. And the cost of living as recorded should be allowing people to have the same expenditures, but what you're finding is across different service sectors and so on, they're feeling the pinch. We have had a prolonged period of interest rate suppression. Now, I'd suggest to you that even if we had markets without the help of central banks oppressing rates, even if they were low, the difference would be that there'd be less certitude about that persisting. In other words, you're adding a dimension of official intervention which gives people more comfort than you would have if you were simply leaving it to the markets, I suggest. So, how's this been reflected? It's been reflected in extremely low volatility. It's been reflected in a massive crowding into bonds. You have insensitive bond buyers by governments, but you also have some insensitivity by the buyers who are given a mandate to run bond funds. Their job is to try and outperform. They are hugely benchmark aware, and as a consequence are forced in some ways to chase that which is done well. It is momentum investing, which we have never found doesn't result in some problems down the line. The true liquidity of a lot of these markets has been masked because it looks like with ETFs, it looks like with the bond funds that you have liquidity. But our problem is that when these markets turn, you will have two people missing from the normal game, and that is your traditional brokers or investment banks. They've removed themselves largely from these markets. They're not a buffer. And then the degree of shorting that's been taking place in the bond markets is quite low. And thirdly, the volumes you get traded in ETFs in some instances can be huge in relation to the underlying stocks. So you've got all sorts of little explosions that could break out at some stage and create something of more than that. Whether it actually affects economic activity is another matter, but it would nevertheless take some value off listed equities and bonds. If you look at valuations, they're high. There are few places where, as I said earlier, we can still find value, but if you take the Schiller Cape Index, so what they're trying to do is remove cyclicality, and what he shows that at 30 times, Wall Street is pretty much as expensive as ever been, except perhaps in 29 and 2000. Now, there is a change in the constituents of that index. There is some reason you want to treat that with some reservation because these tech companies give reach that was unparalleled in the past, that you could expand yourself into a global market almost instantaneously through the internet and grow very, very fast. So there are reasons why some of these stocks are highly valued, and when you think in terms of capitalization to GDP, in effect, you've had a widening of your GDP reach through the use of through these type of companies. So that's not an indicator I'd use so strongly, but I'd certainly use cyclically adjusted earnings is interesting. And then you just look at the wealth effect. So at the present time, we've never felt richer, that is the lucky few, in relation to average incomes. So that index is at an all-time high, well above the lows of the 80s and so on. But here's the problem we face. As fund managers, when you look at a statistical assessment of what you should be doing, if you go out too early, and it depends how early you get out, but let's say you're out too early by 6 months, you could leave 14% on the table. You could cost yourself 14%. If you leave late, technically you might only be down 10% within 6 months after the setback. So what do? The trouble is, immediately after the setback, it's unlikely to be just 10%. Immediately after the setback, it could be rather more, but I'm talking about a 6 month before and a 6 month after type of situation. So don't believe that we, as fund managers, aren't institutionally bound to play the game till the last second. And that is the interesting point. So keep that in mind when you're relying on the experts. Now let me have a real expert come up and tell you about China.
Yes. So we'll have questions after Andrew's spoken.
Morning, everyone. What I'd like to spend a little bit of time doing this morning is just talking about one part of the market where we think there's an extraordinarily large gap between the general perceptions of what's going on and what we think are the realities, and that is what's happening in China. And one of the things I want to try and do is think about how the news flow hits us when you're reading the Fin Review locally or the Financial Times, if you read that paper, and how very different that news flow is to what we see on the ground. At the beginning of 2016, we think there was a very significant change started to take place in China, and it was in what they're referring to as supply-side reform. Now, my observation, again, just going back to what's reported here, is I have seen a couple of reports about these changes in the FT, in the Fin Review, but they're very cursory discussion. And it's interesting they're cursory because they have made a fundamental difference to two very big markets in Australia, thermal coal and iron ore. The supply-side reforms started in the coal and steel industry in China, and the State Council in February 2016 announced that state enterprises, so we're not talking about the private sector, but the state enterprises which dominate in those two industries, were to close any loss-making capacity, subscale capacity, or any capacity that was not meeting environmental standards or labour safety standards, or that had been illegally built. That was probably more the private side, but those plants were also to be closed. So this is for coal and steel. To pave the way for this to happen, there was a redundancy fund put forward by the central government. So anyone who lost their job as a result of this would be paid around 18 months to 2 years worth of their pay. Now, initially, everyone was very sceptical about this announcement because essentially, if you've been following the state enterprise sector in China, we've heard this multiple times over the last 15 years that these changes should occur. And the reason Beijing wants them to change is because this is the fundamental weakness of the economy. So people were sceptical that there'd be marginal change or someone had closed down a plant for a month and then turn it back on. This time, the actual closures did take place. And as an aside, that is the true sign of President Xi's grip on power, that he was able to make these changes occur. Forget whatever he's done in the last couple of days. He'd had a pretty good grip a couple of years ago by the fact that no one else had been able to make this happen. Why were these changes so important? So if you look at it today, there's over 10% less coal capacity and steel capacity in China today. We know that very well in the coal market because we can see what's happened to thermal coal prices. Export prices of our thermal coal are up substantially in that time frame. What's it done for industry in China? Well, clearly the profitability of those industries is through the roof. Now, that might mean in steel that you're just making some okay profits. It doesn't mean you're having a boom like you were. But then there's another important side effect of this, and that is that the banking system, where this is one of the biggest areas of exposures to state enterprises, the non-performing loans, so this is an anecdotal number, but it's the sort of number that was thrown around, is at the beginning of 2016, probably around 40% of loans to steel and coal companies were non-performing. Several months later, very few were at all. So one of the big fears about China has been this incredible use of credit and the potential for non-performing debts in a whole range of industries that have built too much capacity. So this, in part, has been resolved. But really at the core of the problem that was solved here is that in China you have had the combination of local government, local banks and local state enterprises are at the core of this issue, where essentially the local mayor or governor wanted employment. That's how he's measured. He wanted a steel plant. Why shouldn't his city have a steel plant? Everyone else has one. So he goes to the local state enterprise and say, we need a new steel plant. How are we going to fund that? Well, let's talk to our local bank and make sure that the money gets lent. And that was the deal. And there were another way of looking at this, there were no commercial or budgetary constraints on this type of activity. And so even when things went bad, and things were not, in any commercial sense, you would have closed the plant down. That wasn't happening. So this mechanism has been broken very clearly. And what we see is that it is going across a range of industries. It's not always easy to see exactly what's happening, but what we can see is that a whole range of these very heavy industries where the state enterprises operate, we're seeing improving in prices and profitability, whether that's glass, PVC, in most chemicals, aluminium, and the like. And again, why is this so important to look at this? Well, again, this is the key thing everyone worries about in China, and we seem to have fixed it. Anecdotally today, it's much broader than just the state enterprises, because one of the other areas that is clearly getting attention now is any industry that is polluting. So a whole range of private enterprises who would have been using coal gas, for example, in running their business, have been closed down when there's a natural gas alternative available. So we see a whole range of industries. And again, it's important because it's affecting businesses all over the world. So a very simple example, a very niche example, is that the Chinese produced a large amount of the world's electrodes for steel furnaces. That industry, in short, has been closed down. This has created a tenfold increase in the price of these electrodes for electric arc furnaces. We have a small investment in a company in Japan that makes them, and it's doing pretty well. Now, it's a small investment. I don't think it's a great story to talk about, but it's just an example of how what's going on in China is not just relevant for China, it's relevant for everyone, as it was for our thermal coal exports here. So just stop and let me ask, this has been going on for 2 years. How many of you have read in detail about these changes going on in China? So there's massive improvement in the banking system, but have you read about it? You should have been reading about it because it's big news. What I more read about in China is the problems of the bad debts in the banking system and the excessive use of credit. I mean, they're real issues. But here we actually have resolution. I hear about that there's no reform in China. Well, this is pretty substantial change. And meanwhile, and I won't talk about it too much, but clearly the shadow banking system in China that everyone talks about, and that's a great name, shadow banking system. Our entire country and that of the West is built on shadow banking systems, but it's a nicer name for it, isn't it, than just securitized debt. But it makes it sound pretty scary, and maybe it should be. But anyway, they've clearly very significant changes there and reductions in credit there. But it's important for another reason. What is the Chinese story all about? It is not about state enterprises building steel plants. It is about an incredibly dynamic private economy. Now, you'll have heard about from us and many others these days about the excitement of companies like Alibaba and e-commerce, Tencent, you know, extraordinary businesses that have been built up in this area. But it's much broader than that. So if you look at where money is going into today, it is things like electric vehicles, and China are the leader here in many respects, and they are driving this industry globally. The reason Volkswagen and GM and all the big OEMs are focused on electric vehicles, partly it's European environmental standards, partly to a lesser degree US environmental standards, but it is because they have been told they will not have a market in China without them. And China is where they make their money. So we have a big push on here. Now, it is government policy that's driving that, but again, it's reasonably far-sighted. Whether it's successful, we'll see. Where else is there excitement happening? So in an area that no one thinks of with China is drug and biotech industry, where today they clearly are not just doing generic copies, but have some very interesting companies with very real and serious development pipelines. Robotics, another area. These are the areas we're seeing investment. If you're worried about the state enterprises, there's one area where we see the government spending a lot of money on, and that's infrastructure. Now, I would suggest that probably most of you have read about the One Belt, One Road program of President Xi. It's been in the papers here quite a bit the last 3 to 6 months. That's a 2.5-year-old program, or even 3 years. They've been building the infrastructure projects for the last 2 years. Now, everyone again looks at this in the sort of mystery of the political influence of China in the region, but also China understands one very simple thing, and that is that infrastructure creates economic activity. But even again, if you look at a lot of the commentary around from foreigners about this, they'll see it as wasted money. And you will continually see references in the press to an Oxford University study on how Chinese infrastructure makes no return. And it's a very, we actually got this study out, and it's, I think, someone's PhD thesis from about a decade ago, or using decade-old data anyway. If you look at it, what they're saying is, if you look at the toll roads, for example, they're not making much of a return. I think it's 4 or 5%. But that's not that's the direct return from a toll on that road. The real impact of infrastructure investment like that is that you bring other parts of the country into the modern economy. So they want to connect China to the rest of Asia and to Europe with infrastructure, and it will open up possibilities for populations and regions as they do that, and with it, greater economic activity. If there's one area, you talk to bankers in China where they're prepared to lend money to, it's infrastructure. And I doubt, and as they're lending to the government, I think it's easily afforded by the government in terms of the payback to them through taxes and so forth. So I think there's a very different story, very positive story about China. It's the one about private enterprise growing very quickly. The more that we get the state sector under control and out of its way, the better. And so again, we look at the characterisation of that in the press with you know, the recent events of the party congress and so forth, and it's all characterised as Xi wanting to emphasise the role of a strong state sector in the economy. And indeed, it is that, but it's a rational, sensible state sector in that economy, and not one that wastes the country's resources. So, final thing to think about is that we look at the markets. People are fearful of all sorts of things, whether it's the valuations in the US, central bank policies, excessive use of credit everywhere, and they're all worthwhile things to worry about. But what I would put to you is this one thing, that this place, China, is, you know, in a sense for some people almost like a pyramid scheme that's all going to collapse. I think it's rather not. I think it's rather actually the great opportunity for investors. For us, in our portfolios, it's about the individual stocks. You know, we're not buying China because of this. We're buying it ultimately because of the individual companies that we can buy there. But one of the reasons they're cheap is because of the sort of fears that we still see printed on the front of the paper more days than not. Anyway, I'll leave it there and get Kerr back up, and very happy to answer any of your questions. Thank you very much.
So please just put your hand up and a microphone will be brought around to you, and then you can fire your question at Kerr or Andrew.
I'm Matthew Ruber. Just a question, I think, probably for Andrew. I remember reading an excellent piece on the payment systems developing in China and all that sort of thing a few months back. And I'm just wondering, obviously those systems developed because there was a lack of terminal infrastructure and all this sort of thing, and Visa and MasterCard have had difficulties penetrating that market in the same way that they did obviously in the West. But what do you think about the reverse penetration, the ability of these sort of you know, peer-to-peer payment systems to penetrate Western established payment systems? What do you think?
Yeah. That's a really good question, because that was sort of what you know, we've had quite a debate about, and I think that interestingly, other people have tried these sort of things before in the developed markets, and the friction in the system that's hard to get past is, one, the existing system works. You know, you take out your card, and with tap and go these days, it's even better. And the loyalty schemes underlying them provide a real barrier to these new types of systems. So, but nevertheless, everyone's going to be there, you know, setting them up and trying them, and I'm sure Alipay, you know, well, is already available in Western markets, so it's going to be there. But I think there is real friction that means it may not be that dramatic. We'll see. I certainly would be very wary of owning the classic, you know, Visa and MasterCard stocks, but, you know, timeframes can be long. I think probably more interesting is, you know, places like the emerging markets, where certainly the payments, the card companies are there, but, you know, if you go to a place like Brazil, not that many people have a credit card, and, you know, they may not have a bank account, etc., etc. So I think, you know, you will find these systems take off in the emerging world, and India certainly have a system that's coming through very quickly. So I think, if nothing else, it's going to be a greater loss of opportunity in terms of the future growth than perhaps, you know, being too dramatic in the near term on how it impacts those companies in developed markets.
Sure. Thank you.
Thank you. I went to Argo Global Infrastructure meeting yesterday, and you seem to be hitting a particular point which is coming up. The thing that amazed me was the sheer money which is now being raised, or has been raised, which is sitting there ready for infrastructure. So it looks like, and I'm after your sort of concept, that perhaps we are having a worldwide infrastructure boom, and I'm wondering how you see that playing out on the supply and doing side.
I wouldn't like to suggest that it's worldwide yet. I mean, I think in Asia it's been led by government policies in China. The trouble is in the States, you know, the interesting question is, should they be trying to pursue these tax reforms when they don't seem to be making much headway, or should they be running some deficit spending? And unfortunately, I think the tax debate will take precedence over a more considered view about deficit spending on rebuilding their infrastructure. So they'll give tax breaks if they finally get it through. And so that's going slowly. However, the stocks there, providing stone, bricks, cement and what have you, been very good. So that's true. But in Europe, you're not seeing this boom yet. So I think it's pretty much the Eastern Hemisphere at this stage. Whether it kicks in is an interesting thing. And of course, the Canadians were the first to spot this opportunity as an investment. And they seem to be pulling back a bit now, which is interesting to me.
I'll just add on that. I mean, there are quite a few aspects to that, because there's what's being sold to us as individual investors is this idea of investing in infrastructure, and that is just you know, it's been awfully good simply because interest rates are where they are. But when you look at what's going on in China, there's a very different philosophical point of view here. It's not about building a road and getting people to pay for it. You know, maybe they do. There are certainly toll roads there. But it is about the much greater return to the whole economy. So I think it actually shows the perversity of where the West has got to, is that we only want to build a road if, you know, the people who get on it pay for it. Whereas in fact there's huge returns to the broader economy, and the fact is that you may get even better returns if we weren't made to pay for it. So anyway, I think there are a lot of different things there. There's economic policy, there's your position as an investor in these assets, which I've been, you know, generally people are pretty enthusiastic about, which would lead us to be fairly cautious about owning them.
I haven't actually heard it come up, but the suspicion I have is that part of the thing that is developing is actually the Western need for regular income for the retirees in the baby boom, etc. Can you comment on that?
No, well that runs through everything that's happening in markets globally. I mean, that is the obsession with yield, and understand the need for it. But the problem with it is that you've got to look at the underlying reality of the assets that are giving you that yield, and that's where, you know, I think, and I'll say I because it's probably a bit more debatable, but I think Australian banks are a terrible investment. They can only give you that yield that you see. It can grow a little bit, and maybe you will get that yield, and maybe it will grow a little bit for the next 10 or 20 years. But there's plenty of room to have a credit cycle at some point, and then you're going to get a whole lot less. And to me, that's a pretty uninteresting starting yield if that's all you can get. I want to buy something that's giving me a yield and is going to do better, is going to grow. It's, you know, so I think it's a fairly, what you're mentioning is run through markets the world over, very much so.
Right. I don't want to monopolise, but it was also interesting the fact that they're recognising the risks of driverless cars and satellites development and everything like that, and that the whole infrastructure. My point at that meeting was the fact that, of course, infrastructure, you can't just take up a road and move it. So I'm just sort of a bit wary on the type of infrastructure.
What is that risk? And if you see a company, do you say that company is just to risk profile. How do you gauge it, and how should we gauge it?
The long-term return from equities in the US, and for other markets I'll give you another number, but for the US it's about 6% real over 120 years. And then you've had about 2.5–3% inflation. So that's what you want to earn over a long period of time. You want to then assess against that how much above trend you are. And that's where it gets difficult, because what you've actually seen in the last while is a re-rating of shares on the problem of oppression of rates to try to ameliorate the full effect of debt being so large and oppressive. Because if we had interest rates at a uninterrupted market clearing level, and I think it is being interrupted, you would find some real problems with governments meeting their obligations and companies meeting their obligations, and individuals indeed. So I would like you to use that as unless you think there's a regime change, I think we can correctly believe that we might get 6% as a trend. So start at any number you like and see if you're above trend or not now, but use at least 50 years. And incidentally, the second half of the last century was a higher returning period than the first half. The first half you got about 3.5, the second half you got about 7.5, 8. And I don't think capitalism is becoming more profitable, a higher return of the cake going to capital as against labour. That's been the trend, and I think labour should get back some at some stage. But that's a big leap from where we are right now. So I wouldn't put money on that now, because we have still the whole automation cycle coming through, even though we have less deflationary pressure from a big market like China. So a long answer, but before Andrew says it, remember that the MSCI is devised by those who pay MSCI to have this measure. So our beloved China, which is probably the physically the largest economy in the world, has a princely exposure of 3.5%. If you then add other territories that include Hong Kong and Taiwan, you get a representation for this very large economic bloc of 8%. So that's why we have some problem with this MSCI. We love it now. We've always loved it. But we think it'll just be perfect for us for another while. Andrew.
Would you use another index in preference to it, or?
Cash. Cash has certainty, and I don't think we probably will have a little more inflation than we're pricing in now. But cash has the beauty of certainty of value, and it gives you flexibility. And I was saying to these gentlemen this morning, cash is the one asset today in a much loved asset market that is despised.
Kerr and Andrew will be outside afterwards having tea, coffee and biscuits with all of you, so there's plenty of opportunity to have some private questions. But are there any more public questions you'd like to ask while they're up here? One more, please.
Given that there's been some interesting articles in the press of late, for example, Morning Star, the lack of growth in the bank sector is, I don't know if it's been of as much concern as it should be, because there are so many mum and dad investors, etc., who have followed banking sectors. What do you think we could do? How do we raise awareness that perhaps, well, looking at a number of the banks, there's very little opportunity for growth?
So one of the the things with the banks is they're one of the easiest companies to predict their growth rates because, you know, it's a pretty simple business. You know, you take deposits, you lend, you do a few other things that are similar. But we can observe their return on equity, and, you know, they're regulated by the amount of equity they keep. So the Commonwealth Bank, the current return on equity is of the order of 16%. The dividend they pay out to you is 3/4 of their earnings, which means their equity only goes up by 1/4 of 16, so it goes up by 4% each year. So that tells you what their underlying growth rate is, unless they become even more profitable and their return on equity goes to 17, 18, 19. At the levels of return on equity that our banks have, they are off the scale globally. Profitable, yeah. So that return on equity is very, very high. So, you know, there is just a limitation on what they can do. You can really only expect, you know, a very, you know, that 4% growth is a reasonable expectations. Maybe next year it'll be 5.5%, and the year after that it'll be 3%. But that's as good as it can get, and that's just the reality of what that business is. The bigger concern I have with the banks is we've had 1992 was the last time we had a credit cycle. And the beauty of our banks would have been similar to the beauty of the UK banks or the Irish banks or, you know, the American banks pre-2007. And we see what happens when you get a credit cycle. I'm not telling you there's going to be one tomorrow, but in all likelihood there's going to be some event at some point that you know, with the level of debt in our households, there's going to be an accident at some point. And, you know, you're going to get your 5.5% fully franked yield out of the Commonwealth Bank until the day of that accident. Now, if that accident doesn't occur until 2050, then we're all probably pretty happy with that.
Yeah. The level of household debt in Australia is enormous.
It's extraordinary. And I think, look, there's a very, it's interesting. We talk a lot about housing prices and what have you, but, you know, for the record, the independent surveys, like of global housing prices, outside of cities like Hong Kong, Shanghai and Beijing, which are incredibly, you know, incredible income disparities, you know, we've got the most expensive property prices in the world at 12 times average incomes. Now, the other city that is up there is San Francisco. They happen to be sitting in the middle of one of the great booms of all time in terms of, you know, what's happening in the world of e-commerce and what have you. And we're really not quite that. So yes, what's the answer? What no one really ever asks is, how do we get there? Why are we there? And it's not a, you know, there are things like negative gearing and all of that people talk about, and they're real, but really it's actually about, I think, you know, I can't say I have all the numbers to back this up, but it's clearly about income disparities, and there's a group of people who basically are the 50 plus who have accumulated huge wealth with huge tax benefits into their superannuation. And what are we doing with it? We're investing it maybe in shares, maybe in property. And, you know, that group just aren't paying their fair share, I hate to say. It's not a popular message, but, you know, that's the reality. If you want to adjust property prices, adjust their income levels, and we'll adjust property prices.
Any other questions before we call it to a close? Well, thanks very much, Andrew and Kerr, and thank you all for attending today, and we'll see you outside.